Thanks for joining us today, everyone. I'm glad you could make it to the next edition of Market Matters. I think this is a really timely edition, of course, because we've got the situation in the Ukraine, and I look forward to sharing with you how we're adapting to the current environment, but also maybe some opportunities that we see along the way. I would also mention that haven't mentioned this in a while, but if you have any questions, feel free to lob those into the chat feature of Zoom. I'll try to grab those and address them as they come in. And if I can't address them real time, then we'll try to get with you all at the conclusion of this meeting. Additionally, we're always looking around for or open to suggestions you all have on content you want to see or would like guest speakers on. Periodically, we've had guest speakers on that have been pretty high quality, either from political consultants or cyber consultants, doctors talking about COVID. If there's anything along those lines that you find interesting or you'd like to know more about or have a speaker on, we'll see if we can line that up and get them on to the next Market Matters or ones shortly thereafter. So with that, let's get started. So here's the tentative agenda. This will likely take us through most of our time, even though it's a short agenda. It's lots of meat in each of these topic areas. And I thought we would talk about the Ukraine situation before the outlook because it does provide a needed context for some of the recommendations we're suggesting. So let's take a look at the economic update first, which I think there's, similar to last time, there is a need to just understand what's going on with Fed funds or the Federal Reserve, because they are and continue to be a wild card. And what you see here is the S&P around times of not only all-time high we hit very first part of January, but also when the Fed minutes were released. And the point I would just make, and we've kind of been in a little bit of a downtrend since that time, but the point I would make here is that we've got a meeting coming up in 2 weeks. The Federal Reserve, I think it's over the 15th and 16th, will be deciding for the first time post-COVID what the forward-looking monetary policy situation is going to look like. And this is a meaningful decision, not that I want to belabor the Fed decisions too much, but it's a meaningful decision because this will likely be the first time that we raise interest rates in a number of years. And some fear that we are already behind the curve as far as that's concerned, meaning that we have, potentially a much larger rate increase ahead of us than some expect. That is not our base case, but that certainly is something that's been kicking around various policy circles, and we'll just have to see how those conditions evolve. GDP, global growth, is interesting to take a look at, or certainly important to note, because I think that certainly provides a nice base around which we can formulate some opinions on the economy and thereby asset prices. And I guess the good news is for Q1, as opposed to the update we provided you in January, which was a 0.10 growth estimate for GDP in the US in Q1, it's now up to the level of 0.6, which is nothing really to write home about, of course, but it's certainly trending in the right direction. And I would also suggest that some of the data points that have come out today, whether it's the ISM manufacturing index, came in above expectations, or even potentially the services sector, which is supposed to be potentially a better than expected report. This number will likely come off to a higher level here in the near future. But I would say, the base case where we still do not expect a recession in 2022. But I would say that that likelihood is actually rising from what maybe a 5% probability 1 month ago to maybe a 10% probability of a recession. So still not our base case, but we do have to account for some of the geopolitical issues that are creating additional commodity price inflation. And this is what I was referring to is what could set off a recessionary conditions. Now, the good news is, of course, I think the US is much better suited to deal with this type of inflation than other parts of the globe. But what you see in front of you are three broader based commodity baskets. One is an energy basket comprised of oil and natural gas futures, essentially. Another is a base metals index, and think about copper, zinc, aluminum, steel. All lumped together in one basket. And the other basket here is agricultural commodities, which corn, wheat, soybeans, things of that nature. And certainly, I think we all know that the energy index, the red line here, has been the standout performer over. This is a 5-year chart. And that actually makes some sense, in my opinion, and I'll show you why in future slides when we get to the Ukraine section. But there's been a pretty systemic underinvestment in energy exploration that is creating a lot of these conditions that I think the Russia situation has laid bare, is our vulnerability in energy as we transition from fossil fuels to green energy. I think there was just some unreal expectations that this would be a smooth transition by a lot of policymakers, and that's clearly not been the case. And so these are some of the outcomes you can get. Maybe speaking to some of the underlying economic strength in the economy are the base metals index. Base metals are used in everything. You think about copper is used in electric vehicles, or steel used in construction of new buildings or industrial purposes. And the fact that we have a rising commodities or base metals index is, you hear the old saying, it's, Dr. Copper is a good barometer for economic growth and activity. I think that's just showing through here, where the copper or the base metals index was actually a pretty decent leading indicator that all was not necessarily right in the world coming into 2020. But now you see it's kind of leading the way higher, which suggests that there's further economic growth in our future, and that a recession continues to be a pretty low likelihood. The one that does have me a little concerned is this blue index here, the agricultural index. And while it does appear prices on average are about the same as they were 5 years ago for things like cereals, grains, wheat, and so forth, that doesn't take into account, I think, more recently, the idea that both Russia and Ukraine are very large exporters of global grains. I think Ukraine exports something like 20% of the world's wheat, and Russia is a similar amount. And so we really haven't seen food price inflation to any major degree in the US. I mean, yes, in certain pockets like bacon or pork bellies, hamburger meat, things of that nature, that they have gone up, but not anywhere to the level that would cause concern. And I think if you just think about what sets off unrest or issues within a society, it usually almost always revolves around food inflation, food price inflation. And this is why, think about the Arab Spring in Libya being the key catalyst for that was, I think it was the price of food doubled overnight. But if we start seeing broader based food price inflation, that would have me fairly concerned about what's going on within commodity markets. Metals, though, and energy, these are input costs that can be typically borne by producers to a decent degree until they reach some sort of tipping point. We're not anywhere close to that at the moment. So it's kind of a mixed bag at the moment, I think, for commodities. And then housing, we did have some good data actually come out this morning for housing, or not even housing, construction spending at both for residential construction purposes, that's single family homes, multifamily homes, like apartments, and then non-residential, things like office buildings, industrial complexes. And what you can see is, coming into 2022, both residential construction spending as well as non-residential are posting gains year over year of about over 10%, which just suggests that there is that producers or developers see opportunity with economic growth in various areas. And even this is despite, of course, the fact that mortgage rates have risen about a percentage point from their lows about a year ago, or a year and a half ago. I think the average mortgage rate went from 275 to 375 over the course of the last year. And I think this just tells you that we've still got some economic strength to rely on within this construction and development sector. So that's not presenting any risks. And then let's get to the special topic, which of course is the Russia-Ukraine conflict. We alluded to some of these items or areas in the special 2 minutes update I put out last week, but I did want to talk a little bit more about that situation, how it's evolving our thoughts on the markets. And I'm not going to necessarily read all of these because these are just concepts and ideas here at the moment, but I do think it's important to help understand, some of the items that we had taken or adjustments we have taken to our portfolios in advance of anything that happened with Russia and Ukraine. First idea here that maybe I wanted to touch on is that we have removed and had removed almost all of our exposure to emerging markets coming into 2022. We had a very small EM position within our equity strategy at the latter part of 2021, and eliminated or reduced significantly that position well in advance of this particular conflict. And our thoughts really haven't changed on emerging markets, and that is, we really don't see a place for emerging market equities in the portfolio at the moment. Broadly speaking, yes, there can be single country opportunities that come around, but we're going to leave that to an active strategy to find those single stock opportunities within a more global portfolio. But really allocating to a broad-based emerging market index at the moment really has little value to us at the moment, because of these exact types of issues that tend to pop up within emerging markets, where there's tends to be political leaders that have little respect for rule of law or their populations for that matter. And so this was just kind of a natural outcome of what was likely already a prickly situation in Ukraine. The odds are, and I think everything I've read from a number of different journals that we tend to follow, or people tend to follow, is that the odds are this still will be a more localized conflict within Ukraine. So many of the commentators that I've paid attention to or read see little reason why the Russians would extend their gaze past Ukraine. Really, it appears as more of a regime change effort than essentially taking over vast parts of Ukraine. And that is kind of our base case, and we'll continue to stick with that until maybe some situation or the fluidity of the situation changes. And I think it's important to remember too that internal resistance has been much stiffer for the Russian forces than maybe they had originally contemplated, which is a great thing, because now it's giving time for the sanctions to have the appropriate level of bite. And you're already starting to see this happen within the Russian oligarchy class, where they're pulling their yachts out of ports across common law countries across the globe for fear of expropriation, or moving assets back to Russia if they can. But this is already, I think, the more pain that we can inflict from sanctions on the Russian elite class, the less popular this ground or kinetic conflict is going to become at home. And so that would, certainly formulate a quicker end potentially than maybe what the market is expecting. And I would just reference this chart. I did mention it in the 2 Minutes podcast, but I just wanted to show and share with you a lot of the geopolitical events that have occurred over the last 50 years. Is not all encompassing. There's a few in there that are missing, notably. But this is just a good data point to wrap everyone's head around, which is, geopolitical events tend to be localized, and they tend to be pretty fleeting, because there is always a resolution at the end. Whether it's the resolution people want or not is not the question. It always resolves itself. Sometimes it's quicker than others. You can see here Pearl Harbor attack, obviously World War II, took some time to prosecute and come to a logical conclusion. And then others, like pulling out of Afghanistan last year, or the Iranian drone strike that we did in 2020, tend to be very short recovery time periods. But even you have things like Pearl Harbor, or even the North Korean invading the South. These tended to resolve themselves at some point on average from the low. Once you find the low, it takes about 20 days since the start of the event. And then once you find the low, it's about 43 days to conclusion on average. And of course, that's just an average, some longer, some shorter. And this is the market impact on average. And then I wanted to include this chart here because there are a few events on this one that weren't necessarily captured in that prior chart. Importantly, I think the first Ukrainian invasion in 2014, where Russia took over Crimea, shouldn't be overlooked, because yes, the market reaction has been a little more visceral this time around. But you can see 6 months later, 1 year later, the S&P recovered, 8% and 12% respectively, or even things like the Iraq War in 2003, or even the Iran hostage crisis. We've had, pretty substantial recoveries. The one area, of course, we didn't have, which really isn't a geopolitical event, but more just a political event localized to the US was Nixon's impeachment. But in every other case, we have a pretty substantial correction or a recovery 6 months and 1 year later. And I think looking at where we've got exposure and why this is such an important issue for Europe in particular, much less so the US, because we don't have any tied economically to Russia of any significant amount. You can see why this is really important to the Eastern Bloc of former Soviet republics, Latvia, Serbia, Estonia, Finland, and the reason is because they import, and this is from a variety of different agencies, but they import somewhere between 90 to 100% of all their gas into their country from Russia. So you can see the response from Germany took a little bit of time to activate, but now I think they've finally got religion on this topic and are on the right side of history now. But they were very hesitant to do anything or say anything initially because of this dependency. And now I think they're starting to realize that they need to be on the right side of the issue. But this is, of course, not an issue for the US because we actually could potentially play a role here in supplying Europe longer term with gas. And I think Germany is already committing to at least 2 liquefied natural gas or LNG import terminals. Poland actually started this whole trend a couple of years ago by building an import terminal from specifically to take on US gas. And I think that's going to be probably something that we'll see more often. And so that would potentially factor into investment opportunities that we're looking at would be those types of companies. We do have some exposure with some shipping companies we just added to our single stock strategy. But whether or not we can actually get exposure to LNG pure plays, we'll see how that all evolves because there are a lot of opportunities. And just wanted to share this chart because I do think it is important and instructive as to how and where this energy crisis is coming from, because some will probably consider it a crisis, particularly if you're in Europe right now, where energy bills have basically quadrupled in the last 6 to 12 months. What you see here in the yellow line is global primary energy fossil fuel use, which is just a combination of gas and liquefied natural gas, and then gasoline, diesel, and distillates, all combined into one metric. And you can see here that demand for these types of energies has not gone down, but what has gone down pretty precipitously since 2015 has been the amount that super majors like Chevron, Exxon, Total, Shell have committed to finding new sources of energy, because right around this time is when the ESG movement started to gain traction. And furthermore, you had right around this time as well, big petroleum exporting countries like Norway, their sovereign wealth fund committed to divesting entirely of fossil fuels. So you had a massive global divestment of energy companies and an underinvestment, which is creating this supply constraint, which is likely to be with us for some time, because you can't very easily start production in ultra deep water, for example, which is where incremental oil can be found right now. You can in West Texas using fracking, but that it runs into its own environmental issues. So this is likely a lot of information just to say that the higher energy prices will likely be with us for some time, barring some recession or exogenous event that just really crimps demand. And that certainly does factor into the strategies that we have, or single stock strategies that we have in place. Because as you may have noticed, for those of you that are our clients, we have been adding energy exposure incrementally, as well as mining companies over the last 3 months. And those have all worked out quite nicely with the recent run up in prices across the board. So let's pivot now to the 22 outlook. We still have some marks here on the calendar, or on this chart, from what we viewed in 2021 Q4, and you can see the change. So what's happened more recently, upgrading our view on small and mid-sized companies. That certainly, I think, would be in keeping with the idea that two things. One is that small cap has substantially and mid cap has substantially underperformed US large cap. So from an opportunity set standpoint, you're getting a much better starting valuation in this area than you have for quite some time. We did previously last year downgrade emerging market equities to almost zero exposure, and we've been there for quite some time. And then more recently, we still had some research efforts we were doing on emerging market debt, but I think it's really to be considered almost exactly the same as emerging market stocks, and that is at the moment they are uninvestable because the downside risk is so much greater than the upside return potential. So therefore, from a probabilistic standpoint, we're looking at a negative expected return if you were to average the upside versus the downside together. And in that way, we don't see a lot of value with having this exposure in our portfolio. It does feature into some of the notes here, and I've thinned out these notes a little bit because I think it's a pretty consistent story that we've been telling for a few months now, starting maybe back in the middle of last year, which is that negative real yields in bonds, like even though that situation with bond yields rising has improved quite a bit, it still is presenting quite a bit of a challenge for us to want to have a larger bond component than we would normally have. And in fact, leading us, as you'll see down here, to potentially underweighting bonds at the expense of adding international opportunities, or I'm sorry, alternative opportunities later in the year. Certainly want to have some liquidity available to act on opportunities. I wouldn't necessarily say we've seen any dramatic opportunities emerge as a result of this drawdown in stocks, although there are certain positions that either we've trued up or made position modifications on, primarily on the growth side, that have come down much faster in value than maybe the S&P has. So we still continue to see some opportunities within that part of the portfolio, but that's really where a lot of our efforts have been more recently, is to look at what growth opportunities are emerging now that there's been a pretty sizable sell-off in the U.S. equity markets on that front. And then that layers into growth versus value. I'll touch on that when we get to that section, but I still think it's too early to tell, as I'll show you in just a minute. Exited in emerging market positions in Q1, replaced it with a global strategy. So we just made mention of this because we wanted to make sure you all understood that we have almost zero exposure to any emerging market at the moment. Fixed income continues to be higher quality, shorter duration, which means that we're taking on less credit risk as well as interest rate sensitivity. That has helped, albeit only a small part, in the recent drawdown with bond yields. But as inflation starts to level off, you could see bonds start to recover in price, and I think you're already starting to see some of that today. The 10-year bond yield 2 weeks ago was at 2%. Now it's at 175 and falling. So we have to take note of what the market is telling us, not necessarily what we think will happen. We have to also pay attention to what the market's saying. And with that dynamic at play, the market is saying that inflation will level off sometime in the near future. But that's not to say inflation won't be with us. I think a higher level of inflation should be expected, as we've mentioned for some time. And so we have to think about how that might work from a positioning standpoint, so we're not losing money to inflation every year. And then I would just also mention, volatility between stocks, or not only in the stock market, but the bond market, should lead to, more durable opportunities within alternative assets or strategies, as the year progresses. So whether not necessarily going to have, shoot the lights out performance with any alternative strategy when all assets are going down, but I think the fact that we've got more persistent volatility is really important to alternative strategies that have a good chance of success in their strategy as this becomes a more permanent fixture of the markets. And for those folks that went into our newer private growth strategy, allocating to some of the positions within that strategy, as the markets have been down across the board, whether it's digital assets or venture capital or hedge fund type strategies, might represent a pretty interesting point to add to those. I'll use this chart again because I do think it's really important to keep an eye on, because inflation by itself is not the problem. Persistent inflation, though, above certain levels is really where that starts to bite. And again, the reason that is because with inflation over, in this case, 6%, the reason stocks are coming down is primarily because the price earnings multiple, or the PE ratio, is re-rating lower because you have a higher opportunity cost with fixed income, or not being allocated to fixed income. And so this is really where it starts to bite. But yes, we are above 6%, and this has created some drawdown in the equity and bond markets. But if we migrate back into this, I guess, higher normal range of 3 to 6%, then you can still have positive equity market returns and fixed income returns. One thing I was mentioning to our advisors the other day is, not only is it important for us to re-rate to these lower levels, but it's the speed at which inflation continues to go up and or down will actually help set the tone for a lot of what market prices will adjust to, because fast moves don't tend to be rewarded very, very nicely. And just to hit on this point again from I think a month ago, we definitely shouldn't necessarily fear the rate hiking cycle, because if again, the base case probability, especially in light of what's going on with Ukraine and Russia, would likely suggest that the central bankers globally, and I'm not saying this is a US phenomenon, because the European Central Bank is also queued up to have some sort of interest rate increase at some point this year, that this more recent activity within the geopolitical sphere will likely make them proceed more cautiously, and by extension less aggressively, with their interest rate normalization programs. And I think you can just see kind of that playing out here is the perception versus the reality. Perception tends to be a lot worse than the reality. So we can still experience positive returns while interest rates are rising. Again, it's just about the speed at which that happens. And as long as it's not too dramatic, that you can have pretty decent outcomes in stocks and bonds, for that matter. The old growth versus value debate here continues to rage on. And again, you can see it's been pretty visceral up and down. And basically all we did here was just take the Russell 1000 growth index divided by the Russell 1000 value index to capture those two styles. And if the line is going up, that means growth is outperforming value. If the line is going down, it means that value is outperforming growth. And you can see here, basically since the beginning or middle part of 2020, it's just been this sideways activity. And I think a lot of that has to do with the fact that market participants are waiting for a regime change or a shift change in the interest rate environment that would really dictate the future direction of this style approach. But we'll see how this evolves, and we certainly want to keep an open mind to how we should be positioning. But right now it's right down the middle, equal parts growth versus value across all of our strategies. Maybe some good news, and this is why I was saying, looking at position or opportunities in technology, what you see in front of you is the number of NASDAQ stocks. This is the NASDAQ composite, not the NASDAQ 100. The number of NASDAQ stocks that are above their 200-day moving average. The 200-day moving average is important just because it represents a longer term trend line in trading days that tends to pull in momentum into a stock's price. You can see in a lot of different time periods when you've gotten to the position we're approaching, potentially nearer term or at right now, that there tends to be a sharp snapback. So you can see back in COVID era, only 10% of NASDAQ was above this 200-day moving average. Q4 of 18, remember that was when the Chinese devalued their currency, creating a lot of drawdown in equity markets of about 20% during that quarter. 13, 14, and 16, that's all relating to the European financial crisis. We're at that point around 20, so there might be a little bit further to go here. But we're getting to that point where we're approaching some pretty extreme oversold conditions in the NASDAQ in particular that might suggest technology is worth another look. We haven't made any call on that quite yet, but just it's notable that we're getting there. The S&P, however, is pretty far away from that level. So this is where, again, the differences within the market are really important to keep an eye on. So what this is saying is that of all S&P 500 companies, roughly 46% are trading below their 200-day or above their 200-day moving average. And you can see we got down to some pretty extreme territory in COVID and those other periods that I mentioned. So S&P, NASDAQ potentially could decouple for a short period of time, particularly if interest rates go down from here. That's a very non-consensus view, but it's already starting to occur. And that could represent a leg up for technology companies that maybe a lot of people aren't expecting. So we again, continuing to keep an open mind. I did, just want to point out though, that from a valuation standpoint, as the title suggests, the valuation is getting better in the S&P, but it's still a little bit elevated. So what you can see on the chart here is since back starting in 2012, the S&P's price earnings ratio mapped out forward PE ratio. You can see, back in 2012, it was around 11.5, got down to about 13 in the middle of COVID and popped up as technology really took off. And now we're currently trading at around 18.7 or so forward PE. And this represents it's right at the 5-year average. The 10-year average, however, is around 16.9. So to get down to 16.9, that would mean the S&P would have to fall to roughly 3,800. But that would, if we got there, that would likely represent a pretty firm floor on which to build from there, because that would be another 10% or so drawdown, which would, in my opinion, be a pretty meaningful re-rating in stocks. On the fixed income markets, I should have, this was as of Friday. So I'm sorry, Friday. But I should have redone this to break out today's action. But you can see here, we did pop above this little trend line, albeit briefly, and the Ukraine situation kicked off. And now we're kind of right back down underneath this little trend line here. Certainly, as I mentioned last time, we do think that the longer term trend is probably a bit higher, but nothing dramatic. I think, particularly in the context of with inflation coming down, growth slowing, that there's really not a huge reason for there to be a massive uplift in yields, particularly with the central bank continuing to stimulate and being very conscious of that effort. And then again, where are we getting some ideas that inflation isn't going to be that big of a deal? You just look at some indicators in the bond market. This is the 10-year minus the 2-year. This is one way to measure kind of inflation expectations in the short end versus the longer end of the bond market. And as this level approaches zero, it just tells you that less growth in the future will lead to potentially less inflation in the future. Because if this gets down to zero, it means that there's likely going to be a recession in the next 6 to 24 months on average. And if that were to happen, that would really reset expectations for inflation lower, because inflation or recessions are one of those things that really do the job of resetting all of these metrics that might be running hot. So, if anything, this is one of the reasons why we think that inflation should absolutely be tapering off within the not too distant future. There was it's taking from the title, the new bond movie, No Time to Die. But there's really just no time to take on risk in bond markets. And I think this is just emblematic of our thoughts that, fixed income right now is not a place to be taking a lot of risk. And you can see that kind of playing out here in spades within these, more exotic parts of the bond market. You can see the blue line here is the EM dollar-based EM bond index. The black line is the EM local currency bond market index, and then this is the high yield bond market. It's all year to date. And, as I've always told clients, the ability to lose, more than 8, 9, 10% in a bond, strategy is just really untenable, because the risk reward is not 8 or 9, 10% to the upside. It's all asymmetrically skewed to the downside. Therefore, why even bother? It's kind of been my approach and our approach. And then, before we conclude, I'll just leave you with a few takeaways. Again, if you have any questions or comments or thoughts, please lob those into the chat feature, and I'll try to address those on this call. But, just some general thoughts to part ways with here. We still continue to find favor in stocks over bonds. We do have capital market forecasts that we base these ideas on. Stocks continue to have a far superior outlook than the bond market does at the moment, because we still consider bonds right now a capital preservation sleeve as opposed to any meaningful income generating sleeve based on where yields are starting. And we do continue to favor active strategies within this bucket. If we do have to own some, fixed income, we do continue to favor alternative strategies over bonds. So to the extent we can incorporate either private alternatives or liquid alternatives into those buckets, both sleeves have done quite well on the income generating side. So we still think this is a great place to have allocations if you're looking for income, is in the alternative strategies. And I think the volatility within both of those markets, stock and bond markets, is only improving the return outlook. We are looking at accessing through some of our newer private vehicles to access strategies we really haven't had a lot of exposure to in the past. And I think we're having great entry points for some of those here in the near future, given some of those dynamics I just mentioned. And again, I'll just go back to, this is a blocking and tackling year. 10% down is pretty much par for the course for any given year. The fact we haven't necessarily had that or experienced that in 3 years doesn't mean we're more likely to have it necessarily, but it does mean that is the expectation. That's the cost of being an equity investor. And I think the cost is getting a little bit higher, in that as central banks and others manipulate or step on the bond markets, for that matter, that it's only the volatility in the future is only going to get a little higher in the equity markets. But that's not necessarily a bad thing, because that can help us gain more attractive entry points. We can also engage in things like rebalancing more frequently, which generally is a good thing, and engage in even things like tax loss harvesting for positions that might be temporarily out of favor. As always, we remain willing to answer any questions you might have if there's anything that comes to mind afterwards. So please feel free to drop us a line and I'll try to get back to you as soon as possible. But until then, I think Hank will be on our next Market Matters. That'll be the quarter end wrap up in April, early April. So we look forward to seeing you then, and have a great rest of your day. Thanks, everybody.